Welcome, welcome, welcome to Wealth Strategies Unleashed. I'm Robert Gilliland with Concenture Wealth Management.
And I'm Mike Alexander, the CIO for Concenture Wealth Management.
You know, Mike, Happy New Year. Happy New Year to all of our listeners. 2023 was an absolute fantastic year. And I know we're getting a lot of questions about what's 2024 going to be like. And with you being the CIO at Concenture Wealth Management, let's have a conversation here just kind of about what should people be expecting as we look forward here into 2024?
Yeah, first of all, Happy New Year as well. And, you know, a couple of things. Obviously, 2023, perhaps a better year for a lot of investors than maybe they might have thought, especially in an environment where interest rates were on the rise for the better part of the year. The markets kind of whipsawed. We had a 10% correction thrown in there. And, you know, by and large, things actually finishing quite well for 2023. And so as we look forward to 2024, I kind of break things down into kind of four things, you know, and that would be, you know, what are the things that we're monitoring? What do we see are the risks? What are the opportunities? And, you know, what do we think, you know, what are the real positives behind you know, our outlook for 2024?
You know, you said something there. And what's crazy is when you go and you look at the return of the S&P 500, let's call it 20% for the year. That's a fantastic year in any way you look at it, right?
Absolutely.
But the reality is that return was driven by 7 companies. 493 companies participated, but not nearly like that. The last numbers I saw is that those top 7 companies, that magnificent 7, they returned over 50% for the year. The 493 were up 2-3%, somewhere in that neighborhood. What do you make of that? How does that look forward to 24?
Yeah, a couple of things. I think, you know, the way that you can think about many trends in the marketplace is that in many cases, they tend to go farther than you thought they would have, should have, or could have. And I would say that has been the case for the Magnificent Seven. I'm not here to tell you that those companies don't represent leadership, but one thing that would be healthy for markets, and this would be kind of along the lines of some of the risks that we would see in terms of 2024, and that is that there's been so much concentration of performance that what you'd really like to see is you'd like to see some broadening of that. Now, in the latter part of 2023, we've begun to see some what I like to call bombed out names. So names like, you know, some of these small cap names, financials, some of these areas that have not participated in, you know, for most of the year. And as a matter of fact, we're actually in negative territory for a better part of the year, finally beginning to kick it in gear. Now, whether or not that's actually something that's sustainable, I think is one of those risks. But I think for a lot of investors who are diversified, they kind of looked around and said, gosh, the market seems like I'm reading that the market is doing a lot better than I feel like I'm doing. And I think that's exactly the point that you just made, Robert, which is, you know, when you have 493 companies, not to mention all of the companies that are outside of the S&P 500 that really have not participated.
You know, so as we look into 2023, what are the top 2 things that are 3 things that you're kind of like, okay, we got to make sure we keep a very close eye on this because this is going to tell us we're in for a rocky ride?
Yeah, so a couple of things. Look, we know we've got a presidential election in 2024. I don't think that comes as any surprise. History tells us that in a 4-year presidential administration, it's typically year 3 that is one of the better performing years. The second best performing year is typically year 4. So think of it as politicians really wanting to grease the skids for their own reelection in the year prior. So there's a lot of policies and a lot of spending, a lot of deficit spending that actually goes on in those years. And they kind of try to continue that in the year of their reelection. And so typically when you have an incumbent running for reelection, that's usually a positive for markets. So that would be one thing I think that we would be looking at.
In fact, I don't mean to step on you, but in fact, I've seen the statistics that show that every single time since 1952 that there has been an incumbent running for president, the market had, without regard to whether they won or not, the markets were positive in that election year.
Yes, and it's just one of those things that it's kind of like I don't need to know really what the outcome is. I just need to know who the players are, and as long as there's no outlier in there, so there are things that you can think about, and I think they kind of dovetail from things we're monitoring, but to things that are risks. So an example would be, what if you get into the middle part of the year and all of a sudden the incumbent decides that he's not going to run. Well, all of a sudden that that history that we've had in place all of a sudden kind of gets pushed to the sideline, and so it actually becomes a risk in the marketplace. But it's one of those things that we certainly want to monitor. So that's one of them. The second ones are going to be the second one I would say is earnings estimates. And so right now, earnings for the S&P 500 are expected to grow at roughly 12%. It's not uncommon for those numbers to be adjusted as we roll into the years. So I'm not going to tell you that the bar is set extraordinarily high, but it's not a low bar either. And so if, for people that have been, they've been worried about the dreaded R word recession for years and years, and that the Federal Reserve may have, maybe overstepped a little bit in terms of, its impetus in terms of continuing to raise rates, that all of a sudden becomes something that we would want to monitor.
So something that's interesting about that is, 11, and we've talked about this before, 11 out of the last 13 times that the Fed has been in a rate hiking cycle, they've caused us to go into a recession. So odds are, if there's a better chance that we end up in some form of recession. Now, that's not necessarily bad for stocks per se, right? Because they're going to have to cut interest rates, which would probably be good. It'll be kind of interesting to see if right now the numbers seem to think that maybe this will make it the fifth time that they're able to make it through. So we'll see whether or not we have a recession, but I do think we've got to be prepared to be nimble in the management of that. What had you really, really, really excited about this coming year?
Yeah, so here's a couple of things that I think are really exciting. We talked a little bit about government spending and how they tend to try to really grease the skids for their reelection. Well, one of the things that the current administration has done is there's a lot of deficit spending that really doesn't kick in until the next few years, if you will. And so some of that stimulus, if you will, is going to kick into the marketplace. And so some of it has to do with infrastructure. Some of it has to do with inflation reduction, but a lot of it is, it's the kind of spending that we could argue all day whether or not it's the type of spending that we really need to do, given the situation that the government is in, if you will. But nonetheless, these are things that have already been passed, and so unless they're undone, if you will, they come to pass. So there's some additional stimulus that can actually hit in the marketplace. The other thing is that despite the fact that we talk about the situation our government spending or our government balance sheet is in, the consumer and corporate balance sheet is actually in pretty good shape. We've seen a lot of corporate buybacks that have begun to occur again here in the fourth quarter of 2023. Consumer balance sheets and it look like they're in really pretty good shape. Their ability to cover debt seems to be quite good, and I would say that the consumer thus far remains strong. That's not to say that they won't eventually be impacted by higher rates, but it helps that they actually came into the situation actually pretty good. Unemployment remains pretty low. I think there is an expectation, and I think the Federal Reserve would like this, but there's some expectation that eventually it begins, to rise. So that's on the economic front. Now, on the market side, I think this leadership of technology as we move through the digital age, I think is pretty exciting. It remains to be seen who the real winners in the long term will be, but we have a rising tide lifting a lot of boats associated with that. I think the return of returns in fixed income, I think, is pretty exciting, where 2023, a very difficult year, really going back into 2022 as well, difficult years for fixed income. And so for fixed income investors, I think, kind of a difficult environment. Cash is still paying you something. So that's an opportunity. And then perhaps maybe last but not least is that with rates eventually peaking, at least on a short to intermediate term, that could lead to a decline in the dollar, which would we would welcome the return to international diversification. So a declining dollar obviously would help a lot of international assets. So there's a number of opportunities out there.
So when we look back at 2023, we started the year choppy to down. Then sometime in the second quarter, we kind of started this move up, and we get through July. And all of a sudden, felt like the bottom was falling out, right? The markets, we had this massive decline in August, September, and October. Then we have November that was awesome, and December was good. What should investors be thinking, or what should their expectations be when we look at 2024 and we're looking forward?
Yeah, so volatility ending the year was quite low. And so I think the anticipation is that it's perhaps a little bumpier ride, not because we're worried so much about the central bank. So if you want to think about, the big worry for 2023, it was, the Fed is really on its horse in terms of raising rates. And
they were.
Yeah. They were. Yeah. And so as an investor, you feel like you're being held hostage by central bank meetings, and so those were coming up on a fairly regular basis. And each time they were raising rates. Now that the central bank is in this situation where they're pausing, you can kind of think of them as moving to the back burner. And then the broader economy now kind of moves to the front burner, if you will. And that really comes down to, how are companies doing? One of the things that I think that, we've certainly have kept an eye on is that productivity has been increasing, and wage pressures have been decreasing. So, the question then becomes is how fast can we get, how fast can we get to that Federal Reserve's 2% inflation number? How close can we get to it? And do we have to cause any additional damage to actually get there? And so I think, everybody hears this kind of soft landing scenario. That would be wonderful to see. It is very difficult to execute.
Right.
But I think markets have tried to price some of that in. So I would expect a little bit of choppiness as we move through the first part of 2024. I think also the political picture will of course be a little bit clearer as we move towards mid-year as well. So I would just watch the first couple of quarters of next year. But I would say that if everything that we know today remains in place, and I recognize that can change, I think we set up for a relatively decent year in 2024.
So it seems to me that it's still going to be a bull market, but it's going to be a bucking bull market. Diversification may be what saves you through there. That it's a better chance that the markets are higher on December 31st than where they are today. And you have to make sure that you know what you own.
Absolutely.
Inside there. It's interesting. There are some sectors and some of the things that I've looked at that really don't look that good. And you just can't go and throw things up there. Financials maybe are not a great place where you kind of think that you need to be. But those defensive companies haven't appreciated in value like what you would expect if we were staring down a massive bear market. I think investors really have to keep that longer term type of philosophy, because at any point, because I do think we're going to have volatility next year. I think we're subject to a lot of headline risk, right? You got the geopolitical situation, all different sorts of things that potentially could move this market. You have to make sure that you're aware and prepared for that, and keep your eye on the long ball next year, that we may end up having these big drawdowns but we're going to end the year positive. One thing that's real interesting as we kind of wrap this up, when I think about what happened in late November and December, what I found very, very amazing was the number of firms on Wall Street that actually talked about not much growth in 2024. In fact, some big names have said that they expect for the market to actually be down next year. Now, the contrarian in me thinks more people thinking that it's going to be bad means next year might be really good. But what's your take?
Yeah, it's there are always plenty of caveats that we can throw in here. Obviously, geopolitical risk is always a big one. A central bank that really, again, oversteps its bounds. Some sort of risk that is, comes from the outside, if you will. So, we experienced that when we went through the COVID years where, people weren't really expecting something like that. And so it's not to suggest that some of those things can't be out there. But one thing I would point to is that in the last 5 years, we have had 3 bear markets, and we've had 10% correction. Now, typically, you get about 1 correction every year, and so a correction is a 10% decline or more. A bear market being 20% or more. You typically get a 20% decline every 3 to 4 years, not 3 in 5 years. And so, I would just say that bear markets typically don't begin with that type of behavior. They typically don't occur when there's $6 trillion sitting in cash on the sidelines. And they typically don't occur in a situation where, on average, stocks are under-owned relative to where they historically have been. And so I think if you look at all of those various things, again, not to suggest that you can't have something come out of left field and whipsaw markets, but you typically don't have what I would call stealth bear markets occur in that type of environment.
So be smart, be prepared, and maintain your vision. Remember what your outcomes that you need, and make sure you're managing your risk.
100%.
Awesome. Hey, Mike, thank you very much. I hope this was useful to everyone. We'll be back next Monday. Thank you very much for attending Wealth Strategies or listening to Wealth Strategies Unleashed.
We'll see you next time.